Bank Chief Mario Draghi's vow to hold the Eurozone together as investors prepared for US second quarter gross domestic product data due later this evening. Chris Weston from RG Markets joins us now live from Melbourne to discuss all this and more. And Chris, it seems a little bit of a change in sentiment towards the euro despite that slight pullback this morning or that big rally overnight. Those strong words again from the ECB helping, of course, and helping almost everything out there on the market overnight at this stage. Very interesting, though, ahead of the ECB meeting next week and other central banks, BOE, FOMC, all within 24 hours of each other. Run us through your insights, your analysis and how it's likely to place us moving into next week.
I think they've done a pretty good job. They've come out on the offensive clearly over the last couple of days and they're jawboning and trying to stem the bleeding that we're seeing in the bond market, and they've done a pretty good job in that regard. I mean, if you look at Spanish two-year yields in the last 2 days, they're down nearly 150 basis points. Italian yields last night down nearly 90 basis points on the front end, which is pretty good because these guys need to come out to the bond market over the next week or so and raise a pretty decent amount of money. I mean, they're looking to issue 184-day bills, 8.5 billion euros worth. So I think this is good ahead of that. Mr. Nowotny's comments in the previous, he started the ball rolling in yesterday's session with some very, very interesting comments in my mind, talking about potentially or seeing a pro-argument in granting the ESM, the European Stability Mechanism, the second bailout and banking licence. Obviously, therefore, they could tap the cheap liquidity from the ECB and use that to buy back bonds in the secondary market. Now, it's a long way away. It's a million miles away. We still need to see the ESM being voted through the constitutional courts of Germany, which should happen, no problems whatsoever. But Mr. Draghi needs to get on board. But at least we know the ECB are talking about what is one of the measures which a lot of people see as the end game to this whole crisis in terms of lowering yields. Anyway, Mr. Draghi's comments last night. I mean, I don't think anyone really fully understood what exactly the implications of his words were. You know, he came out. I think it was just the definition in his words that the fact he was so aggressive in what he said. You know, believe me, we have enough in our firepower to bring down borrowing costs. And I think it was just the determination in his voice which really scared off a lot of short coverers last night, or short sellers. Big short covering rally coming through in a lot of those asset classes. Now, what does it actually mean in terms of what he's talking about with inflation and working within their mandate? Are we going to see the resumption of the securities market programme, i.e. the bond buying programme, which was stopped at the beginning of the year? Are we going to see another long-term refinancing operation? You know, the cheap liquidity at 1%. Are we going to see the EFSF being used to buy back bonds in the secondary market? Or simply, are we just going to see a tweaking of the collateral rules, which banks can need to have collateral to come and borrow this money? So, you know, that last one there being probably the least effective out of any of them, to be honest. And you know, I think he's done a very good job in jawboning. You know, as we say, euro yields came down quite significantly last night, but he will need to back this up with actions now. That's the issue. Now, in terms of the currency perspective, obviously euro's pushed up, and I think the focus now in the last couple of days has come away perhaps from the euro side of the equation, perhaps back onto the dollar side of the equation ahead of the FOMC meeting. So I think people are now sussing out the negatives in the US dollar. What's going to happen with tonight's US GDP, for example? How does that feed into the Fed's thinking? So perhaps the path of least resistance for me right now is a higher euro. I still don't think any of the issues that we've seen in terms of buying, you know, resuming its bond buying program will solve the crisis in any shape or form. We know that the SMP program hasn't solved that when it was going anyway. So I think, you know, you'd be looking to sell rallies still. But I think the euro in the short term can rally, and I think we could probably, if we get a close above 123.28, sorry, 123.24, which is the 19th of July high, then you can add to long positions in this market, and you can see probably a move up to 125, 126. But you know, I think it's the ECB really do need to deliver what they're in the short term now.
Yeah, exactly. I think you summed it up there, because despite the comments, it's action that we want to see, because we've been rallying and selling on comments and headlines for so long now. We actually need decisive and action implemented policy in place, especially in relation to German officials and Germany's involvement. You mentioned US GDP. Talk us through that. That's the key tonight. How do you see that going, and what else are you eyeing in terms of economic data?
Yeah, I mean, GDP is always a backward-looking indicator, but I think it has a bit more significance because everyone's talking about growth, everyone's talking about US growth and how that feeds in. I mean, the consensus at the moment is we're going to see an actual full second quarter number of 1.4%. That's the number that we're looking at the moment. If you look at the 81 economists, the range is 1.9%. There's several banks, including BBVA, a Spanish bank, looking for about 1.9%. On the downside, the lowest estimate is about 0.7%. So if it comes in consensus at 1.4%, it will actually be the second quarter we've seen in a row where we've seen sub 2%. It's going to be the fifth annualised quarterly number that we've seen out of 5. It's been the fifth out of 6 we've actually seen out of under 2%. I think if we get a 0.7% read, which is the low ball estimate, then clearly that feeds into a very dollar negative scenario, and it will probably play into the Fed's thinking that growth is well subpar at the moment. The other thing you've got to look at is what's happened. We've got core PCE. Now that's the preferred measure of what the Fed looks at in terms of inflation. They don't look at CPI anywhere nearly as what they look at as core PCE. So that's going to be coming out as well. Similar sort of times. They're expecting that to pull back to 1.8%. Their long-term target, remember, is 2%. So anything below that gives the Fed more ammunition to come out and print assets. You've got personal consumption as well, so I think that's going to be looked at quite closely. These are the things you've got to look at. This is going to be the key event risk for tonight, and I think, as I say, the shift has probably been short-term averted from the euro onto the US dollar side of the equation. I suppose, in terms of looking at euro, we've got Spanish unemployment numbers tonight, and they're expected to tick up to 24.7% from 24.4%. You know, there's a sort of a running joke around the sort of trading floors that there's not going to be anyone left to employed to actually run the numbers in the first place. So they're just unemployment over there is in such a dire straits at the moment. So yeah, I think that will be looked at reasonably closely because they've still got these huge austerity measures that they need to push through. And with unemployment at those levels, you know, I think, you know, big miss on that, and you could probably see yields being pushed higher as well. So I think you've got to look at the GDP. Data in terms of stocks, not really a huge amount. I think you've got Merck and Chevron coming out tonight, and obviously see the fallback from Facebook, which was down, I think, about 11% or so after hours. It's down 10% in the session. That stock's going to get smashed tonight as well. Everyone seems to be looking to go short on that name where they can at the moment. But yeah, I think it's pretty interesting. We're coming to some pretty key levels in a lot of these assets at the moment. If you look at the Aussie, it just can't break through that 104.40 level. We're going to need to see a break through that level in the short term, and that will attract more short sellers closing out positions. And I think you could probably run a reasonably long position going once we see a confirmation of that break as well.
Right, Chris, amazing analysis there as always. Thank you very much.